So back in March of 2023, the financial world got completely blindsided. Silicon Valley Bank, a huge name in the industry, just collapsed. It was the third-largest bank failure in US history, and the whole thing happened in what felt like the blink of an eye. And it left everybody asking one single fundamental question.
And that's really the heart of the mystery here, isn't it? How can a bank that's packed to the gills with what are supposed to be the safest investments on the planet, US government bonds, just completely implode over a weekend? That's the paradox we're going to unpack right now.
Okay, so to really get what happened, you first have to understand the bank itself. Let's introduce the main character of our story, Silicon Valley Bank, or SVB, as pretty much everyone called it.
You got to understand, for 40 years, SVB wasn't just a bank, it was the financial center of gravity for the entire tech world. We're talking about a place that served over half of all venture-backed tech companies in the US. These are startups and venture capital firms who are, by nature, super cautious with their cash. They parked their money at SVB because they saw it as a stable, conservative, totally safe place to keep their funds.
But that reputation for stability, well, it was about to be tested in a huge way. You see, the tech boom during the pandemic absolutely flooded SVB with a tidal wave of cash, and that forced them to make a critical decision, one that would end up sealing their fate. This was the start of a massive billion-dollar bet.
I mean, just look at these numbers. The scale of this is kind of hard to wrap your head around. In just 2 years, deposits at SVB more than tripled. They went from $62 billion to an absolutely staggering $189 billion. The bank was literally swimming in cash.
So what do you do with almost $200 billion? Well, SVB made what looked like the safest, most responsible choice imaginable. They bought long-term US Treasury bonds and mortgage-backed securities. I mean, these are assets with basically zero chance of defaulting. On paper, it was the perfect, prudent strategy.
But there was a hidden danger lurking under the surface. It's something called interest rate risk. The easiest way to think about it is like a seesaw. When interest rates in the economy go up, any new bonds being issued have to pay that higher rate. Well, that makes your old bonds, the ones with a lower rate, way less attractive. So as the new, higher rates go up on one side of the seesaw, the value of your old bonds goes down on the other.
And this, right here, this is the fatal error. As interest rates started to climb by the end of 2022, SVB was sitting on $17 billion in paper losses on those safe bonds. And the insurance they had against this risk, the technical term is hedging, a tiny $563 million. So you've got a $17 billion problem with a $500 million Band-Aid. It was a massive, unhedged bet.
So you have this giant hidden risk just sitting on the books. And it was about to become a very, very public crisis, all thanks to the Federal Reserve's battle against inflation.
This quote just nails it, really. SVB's entire strategy was built on one single massive assumption, that the era of super low interest rates was going to last forever. But when the Fed started hiking rates at a speed we haven't seen in decades, well, that bet turned catastrophic.
At the exact same time, the tech boom that started this whole thing was fizzling out. Startups weren't raising huge rounds of cash anymore. Instead, they were burning through the money they already had. So they started pulling their deposits out of SVB. And that forced the bank to do the one thing it absolutely could not afford to do, sell those devalued bonds at a loss, turning those paper losses into very, very real ones.
So the bank now had a serious financial problem. But that problem was about to ignite a full-blown panic, a bank run that would move at the speed of the internet.
Just look at how fast this thing unraveled. It's incredible. On Wednesday, March 8th, SVB comes out and admits it has a problem. By Thursday, all hell breaks loose. Panic is spreading like a wildfire through Twitter, WhatsApp groups, and private Slack channels. Huge, influential VCs are blasting out messages to all their companies. Get your money out now. By Friday morning, it's over. The regulators step in and seize the bank. 48 hours, that's all it took.
If you want to really grasp the sheer scale of this panic, all you have to do is look at this one number. On that single Thursday, customers tried to pull out $42 billion. That's a quarter of the bank's total deposits in one day. No bank on earth can withstand that. It's just impossible. So the collapse itself was contained, but the shockwaves sent regulators scrambling, and it left the entire financial system facing some pretty big, pretty uncomfortable questions.
The government's response was incredibly fast and absolutely massive. The FDIC took the really unusual step of guaranteeing all deposits, even the accounts with way more than the normal $250,000 limit. The Fed spun up a brand new lending program to help other banks that might be in the same boat. And it worked, It stopped the panic from spreading to other banks immediately. But the solution itself raised a whole new set of questions.
Which brings us to our first huge systemic question. For as long as anyone can remember, US Treasury bonds have been the dictionary definition of a safe asset. So if a bank that's stuffed full of them can fail this spectacularly, what does financial safety even mean in today's world?
And what about that bailout? By stepping in and protecting every single depositor, no matter how much money they had in their account, did the government accidentally create a new rule for the road? We've all heard of banks being too big to fail, but did we just create a new policy of too many depositors to fail? And what does that do to risk-taking down the line?
And finally, this might be the biggest question of them all. A classic bank run, the kind you see in old movies, took days or weeks. People had to physically line up around the block. This bank run took a few hours, and it was coordinated in group chats and on Twitter. So the question we're all left with is this: can our 20th century system of regulations ever hope to outrun a 21st century digital panic? That's a question that, honestly, we're all going to be grappling with for a long, long time.